May 9th, 1863, known to history as the night the river burned. You see, on that date, a Confederate cavalry brigade under the command of Brigadier General William Grumble Jones targeted the oil boom town of Burning Springs, located on the banks of the Little Kanawha River in what is now the state of West Virginia. Back then, it was still Virginia. Jones' 3,000 men emerged from the mountains to set fire to oil derricks and wooden barrels used to store that crude oil. Confederate forces also found as many as 300 wooden flatboats, known as oil arks, which were the primary tanker, if you will, of the day, moored along the banks of the river, and they set light to those as well. As the arks burned, crude spilled into the Little Kanawha River, and the fast-moving springtime current carried the burning oil slick close to 40 miles downstream. In that part of the world, the river flows from south to north, so that actually took the fire to the northwest into the city of Parkersburg, which was a major refining center located on the Ohio River. The oil produced at Burning Springs was the lifeblood of a massive industrial machine. The oil floated north from Burning Springs to Parkersburg and across the river into Ohio, which were major refining centers. And then kerosene produced at those refineries was loaded onto the B&O Railroad, which had a terminus there at Parkersburg, to light the cities of the East, New York, Boston, and Philadelphia among them. Initial reports at the time claimed Jones' men destroyed some 100 to 150,000 barrels of oil. Modern historians think that's probably an exaggeration. However, even based on those more modern estimates in the range of 20 to 50,000 barrels of oil, it would have been a massive portion of total global oil supply. Just consider, at the time, it's estimated the entire world was only producing 2 or 3 million barrels a year at best. And most of that global production was from a narrow oil corridor extending from self-styled Colonel Edwin Drake's famous 1859 find near the town of Titusville, Pennsylvania, south to Burning Springs. That's only a distance of about 200 miles. Of course, 1863 was long before the first gasoline-powered cars started hitting U.S. roads, as in the 1890s and early 1900s. This was actually during oil's age of illumination, when the crude, which was then known as rock oil, was refined into kerosene for use in lamps. Rock oil was in the process of replacing whale oil and what's known as camphene as a primary source of lighting. Now, whale oil, the problem there was that production peaked in the mid-1840s due primarily to overhunting. By the 1860s, whaleboats had to spend as long as 3 years at sea just to fill their cargo holds with oil. As a result, prices spiked, making whale oil a luxury option only for the very wealthy. Camphene was the lighting oil for the masses at the time, and it was much cheaper. By the 1850s, the U.S. market for camphene was around 200 million gallons per year, approximately 5 times the size of the whale oil market at that time. However, camphene is a volatile mixture of alcohol and turpentine, with the unfortunate tendency to explode. Even worse, President Lincoln signed the Internal Revenue Act into law on July 1st, 1862, and he imposed a $2 per gallon tax on alcohol. Now that's $2 a gallon in $1863. That's about $65 per gallon in 2026 terms. So pretty big tax to fund the cost, of course, of the ongoing war. The tax was actually ramped up from 20 cents per gallon initially up to $2, but it was really only a short period of time that ramp occurred between 1862 and 1864. And since camphene is mainly alcohol, the price jumped quickly over this period from around 50 cents a gallon before the tax back in 1862 up to $2.50 a gallon by 1864. Meanwhile, most turpentine at that time was actually sourced from southern pine forests, inside the Confederate States of America. So supply for the North was cut off amid the ongoing war, rendering caffeine an even more expensive option. Millions of households switched to cheaper kerosene for lighting in a matter of months, a source of new demand that rendered the Burning Springs raid and the loss of those 20 to 50,000 barrels of oil even more impactful, especially since that was only about a year, less than a year in fact, after that initial alcohol tax from the Internal Revenue Act. So what happens when a huge source of global supply for a commodity or a huge store of a commodity is suddenly eliminated amid a sizable spike in demand? Exactly what we saw in the 1860s, right? Well, of course, the price explodes. The Energy Institute's annual statistical review of world energy actually provides data on real, now that means inflation-adjusted oil prices from 1861 to 2024. Now here's the chart. Also note that I've actually supplemented this chart a little bit by adding average Brent oil prices for both 2025 and year-to-date this year, 2026, and I've converted both of those to 2024 dollar terms to make them comparable to the data we have from Energy Institute and to make it consistent. So look right here. As you can see, in 1864, that's the year following that Burning Springs raid, global oil prices averaged $166.04 per barrel. And again, that's priced in 2024 dollars, not nominal, dollars of the day. In 1865, the year the war ended, prices only dropped slightly to a little over $130 a barrel. Indeed, it wasn't until 1874 that oil prices dropped back to the same level as 1862 before the tax was imposed. And that level was around the mid-30s per barrel in 2024 dollar terms. However, what's most interesting about all this, it isn't really the effect of supply disruptions or sudden changes in demand on prices. We all know what happens there. It's really the inverse, the follow-on impact of a spike in real oil prices on supply. That's the beating heart of the energy price cycle, really all commodity price cycles. And it's very, very relevant to the trends underway in energy markets right now. The first commercial oil well in the US was the Drake well I mentioned earlier. And that's drilled near Titusville, Pennsylvania, back in 1859. This is the early years of the U.S. commercial oil industry. Now that well was drilled to a total depth of just 69.5 feet, and it only produced at a maximum rate of 20 barrels a day. To drill this well, the self-styled Colonel Drake used a 6-horsepower steam engine powering what's known as a cable tool rig. Basically, the steam engine would lift a heavy iron bit to the top of a pole, and it was dropped onto the earth over and over again, literally kind of chipping away at the rock. In January 1861, the Rathbone family of Burning Springs, again, West Virginia now, Virginia at the time, had drilled what's known as the Eternal Center, or the Great Rathbone Well. They drilled that a little bit deeper to a depth of about 140 feet. Using a more powerful steam-powered cable tool rig. This well produced between 600 and 1,000 barrels per day. So it was a real gusher for the time. In fact, it produced more in a single day than the Pennsylvania oil fields did in a whole month. Indeed, if you look at this chart again, and you can see the first data point here is for 1861, and it shows an inflation-adjusted 1861 price of $18 a barrel. That low price was due in large part to that sudden oversupply caused by this Great Rathbone well. However, what's really fascinating is the acceleration of technological advancement and production after that price spike in the 1860s. You see, then as now, it's high real inflation-adjusted oil prices that incentive innovation and investment in exploration and development of new fields, capital spending. In 1865, Samuel Van Sickle laid the first 2-inch iron pipeline to transport oil more efficiently through the Pennsylvania oil fields region. replacing expensive, slow horse-drawn wagons. Think about it. This area can get very muddy at times of the year. Dragging barrels of oil on by horse is very inefficient, very slow, and was actually vulnerable to labor disruptions at times. In 1867, Colonel Edward Roberts, he actually dropped nitroglycerin canisters, that's explosives, down wells to shatter the rock and boost production. Interestingly enough, this is essentially an early form of the hydraulic fracturing process that enabled the shale production boom revolution some 150 years later in this decade, in this century. And in the 1870s, right, these shallow 100 to 300 foot wells that kind of dominated the early years of the oil age were already drying up. So drillers developed heavier bits for their rigs, more powerful steam engines, higher poles, and technology basically to break that 1,000 foot total depth barrier. And they were actually routinely drilling wells in the 1,500 foot range by the latter part of the 1870s. Now, Pit Hole Creek, which is located only about 6 miles from Titusville, and that initial Drake well, that emerged as a new center of oil production in 1865. The Fraser well completed there in January 1865 was to a total depth of 600 feet, and it yielded 650 barrels per day of production. And by June 1865, so less than 6 months later, the region had actually become an overnight boomtown, producing some 2,000 barrels of oil per day from multiple wells drilled into the sandstone at depths of between 450 and 600 feet. Then, as I said, by the early 1870s, drillers were trapping deeper wells, and that included the vast Bradford Field, which is an 84,000 acre region of Pennsylvania and into New York that contained the Bradford Third Sand Formation, which is located at a depth of about 1,000 to 1,600 feet below the Earth's surface. Now, while individual wells in this region often produce less than 100 barrels per day, wildcatters drilled an enormous volume of wells. It was staggering, reaching over 11,000 individual wells by the early 1880s. Now look again at my chart of real oil prices, and you'll see that collapse in prices in 1874. This was an example of a midstream bottleneck, much like what we're seeing today with natural gas in the Permian Basin, where there's copious gas production and just not enough infrastructure to move that gas to areas like the US Gulf Coast or down to Mexico where it can actually be utilized, so prices are very low. You see, high real oil prices in the early 1870s prompted a boom of wildcatting in the Bradford Field, as I mentioned, those 11,000 wells, and a surge in production, right? This quickly overwhelmed the pipeline, transportation, and storage infrastructure of the day in this region. Producers were forced to sell their oil for whatever price they could get locally, resulting in a collapse in average oil pricing. This turned into a golden opportunity for a 35-year-old businessman by the name of John D. Rockefeller. Rockefeller took advantage of the 1874 chaos and price crash to expand his Standard Oil empire from refineries in the Cleveland area where he was based, acquiring the major oil pipelines and storage facilities across the Bradford Field, and eventually the wider Appalachian oil producing region. You've probably heard the old saw that the cure for high oil prices is high oil prices. That's why it's true. Do you see how the price spikes and the era of elevated real oil prices between 1863 and the early 1870s catalyzed new technologies, catalyzed innovation and greater exploration and development spending? Ultimately, that's what resulted in new supply and lower prices later in the century. The technologies and players have changed, of course, over the years, but the underlying pattern remains the same. Now, a lot of people I talk to seem to believe Paul Volcker and the Federal Reserve somehow brought down oil prices in the 1980s through higher interest rates, tighter monetary policy. Now, high interest rates can bring down prices in some parts of the economy, like housing, for example, that are very dependent on long-term interest rates. But the central bank and the broader federal government, to be honest, have little or no influence over the price of crude oil over the intermediate to long term. So look at my chart of real oil prices today. Again, do you see how real oil prices drifted lower in the late 1960s to below $20 a barrel in inflation-adjusted terms? Then through the 70s, oil prices rallied, reaching over $140 a barrel in 1980, the highest levels we've seen since that Burning Springs oil price spike back in the 1860s. Here's a chart of global oil demand. Okay, the blue line is the actual demand line, and demand growth, which is the orange columns on this chart. And I've made this chart between 1966 and 1986. The source is also that Energy Institute Statistical Review of World Energy. Just look how quickly global demand for oil was growing in the late 1960s amid those low real oil prices I showed you. We saw several years of 3+ million barrel a day growth in oil demand, and in 1973 alone, global demand jumped 4.2 million barrels per day. I've boxed this area of the chart for clarity. The reason this did not immediately result in a jump in real oil prices was that global production was also growing at a rapid pace. So supply was growing to keep pace with and in many years overtake demand growth. So look at this chart. This chart shows OPEC oil production growth over the same period. Again, that's 1966 to 1986. And that's the blue column that you see there. And we're also looking at non-OPEC production growth as an orange column. So OPEC, of course, the Organization of Petroleum Exporting Countries. It's the cartel of producers around the world, but mainly in the Middle East, that control supply of oil in an attempt to influence prices. Now, as you can see here, throughout the late 1960s and early 1970s, OPEC production grew far faster than non-OPEC production, right? Meaning that rapid global growth in oil demand was only possible due to rising dependence on OPEC and particularly, again, Middle Eastern oil imports. In total, OPEC production more than doubled between 1965 and 1973, an increase of just under 15.6 million barrels a day, with more than a third of that, some 5.5 million barrels a day of growth, coming out of Saudi Arabia alone, and about 4 million barrels a day from Iran. In contrast, U.S. oil production peaked in 1972 and began to decline. And that's a trend that wasn't reversed until the shale revolution, after 2008, 2009 or so. Indeed, in 1965, the U.S. imported about 2.5 million barrels a day of oil. That's roughly 22% of daily consumption. By 1973, U.S. oil import dependence had swelled to 6.4 million barrels a day. And close to 37% of daily demand came from imports. Now, the broader OECD, Organization for Economic Cooperation and Development, which is basically a proxy for the developed world, the US, Western Europe, Canada, etc., needed to import 12.23 million barrels of oil per day in 1965, but that grew to a whopping 27.13 million barrels a day by 1973. In short, the US, Europe, and the rest of the developed world had increasingly grown complacent about energy security and hopelessly addicted to cheap imported foreign oil, primarily from fast-growing Middle Eastern producers. Now that left the United States and the rest of the OECD exposed again to when OPEC began to flex its muscles in the 1970s, restricting production and pushing oil prices sharply higher. Now look at this chart again. In 1970, real oil prices stood at $14.54 a barrel, which is actually lower than the inflation-adjusted price of oil a decade earlier in 1960. By 1973, real oil prices had jumped over $23 a barrel, more than tripling to average over $73 a barrel just a year later in 1974. Again, remember this is all 2024 dollars. So we can compare prices across this 160 plus year period. So this was all quite a shock for consumers and businesses in the global economy, as you can imagine. The problem is that oil, and more broadly energy demand, are closely linked to economic growth. It's the lifeblood of the global economy. So while the vicious recession of 1973 to 1975 prompted a temporary decline in U.S. and global oil consumption, oil demand bounced back as soon as the U.S. and global economies recovered in the mid and late 1970s. So yes, if the Federal Reserve hiked rates and that tightening sparks the recession, you will see a decline in oil consumption and energy demand, and in most cycles, at least a short-term decline in nominal oil prices, not adjusted for inflation. However, in the mid-70s, that did nothing to change the underlying issues: weak global production growth outside of OPEC, and the energy security minefield caused by an addiction to cheap foreign oil. Ultimately, higher prices will force shifts in both supply and demand that bring the global oil market back into balance. That's exactly what happened back in the 1970s, and it's also what happened back in the 1860s and 1870s, as I outlined earlier. The problem is that it takes time. Short-term spike in oil prices that quickly fades just isn't enough. You need a prolonged rise in average real oil prices to incentive the necessary changes. The 1970s provide a classic example. As I said, U.S. oil import dependence was at 36% in 1973, and it continued to grow even after the oil shocks of 1973 and 1974. By 1977, the U.S. imported almost half, a full 47% of its daily oil consumption. However, over the longer term, there were more durable shifts in both demand and supply is actually more important. But let's start with two examples on the demand side. In 1965, as you can see on my slide here, the most popular car in America was a Chevrolet Impala, and the 65 model only managed about 15 miles per gallon of gasoline. Fuel efficiency just wasn't much of a concern, with gasoline prices so low. By 1985, 20 years later, and after the price shock of the 70s, the most popular car in America was the Chevrolet Cavalier, with fuel efficiency closer to 30 miles a gallon, double the 65 Impala. And how about this? In 1970, the U.S. actually used cheap oil to generate about 15% of the electricity produced nationwide. And that was actually up from just 6% 5 years earlier in 1965. So oil was actually a very important source of electricity generation in the early 1970s. Now, by 1990, this was of course after the 1970s price spikes, oil accounted for less than 1% of U.S. electricity production, mainly in geographically isolated Hawaii. Growth in coal generation, nuclear as well, filled that gap. Even more important were the shifts underway on the supply side of the equation. Now, as we established, the price spikes of 1863 and 1864 ultimately offered the financial incentive for 19th century wildcatters to find new fields like the Bradford Field, drill tens of thousands of new wells, right? And develop new technologies, including pipelines, an early form of fracturing, and steam-powered rigs capable of drilling wells to over 1,000 feet in depth. In much the same way, the energy security and price shocks, right, of the 1970s prompted a new wave of CapEx, a new wave of exploration and development spending outside of OPEC, non-OPEC, and delivered the discovery and development, and resulted in the discovery and development of multiple new reservoirs. Now that included Mexico's Cantarell oil field in the Bay of Campeche, right? The Prudhoe Bay fields in Alaska, and of course the North Sea of the United Kingdom and Norway. Now this all required significant advances in technology to drill and produce oil offshore, and particularly in hostile environments like the North Sea. Back to this slide. Just look at how non-OPEC production, again, that's the orange bars, began to ramp up in the late 70s. Non-OPEC production growth consistently exceeded OPEC production growth all the way from 1977 until 1986. In fact, after oil prices peaked and began to fall into the early 1980s, Saudi Arabia and the rest of OPEC desperately tried to cut production to support prices. Now you can see it in those negative OPEC columns. Those are the blue columns on this chart. Saudi production, for example, actually stood at over 10 million barrels a day in 1980. Fell all the way to 3.6 million barrels a day by 1985, just 5 years later. Yet even that wasn't enough. That restriction in production wasn't enough, because the growth in new non-OPEC barrels, coupled with the demand adjustment wrought by the high oil price environment, are what actually brought down oil prices in the early 1980s. Again, not the Federal Reserve. We saw it again in the 2000s. Here's the chart of annual average real oil prices again in 2024 dollars. As you can see on this basis, oil prices peaked in 2011 at over $155 a barrel. Again, real inflation adjusted terms. I won't belabor the point by repeating this whole story once again. However, it's similar in many ways to what happened in the 1860s and the 1970s. In the late 1990s, the world had grown complacent about cheap oil prices. In March 1999, The Economist magazine even published a now infamous cover story about the potential for oil prices to plummet to below $5 a barrel due to excess global supply, a glut. It was titled "Drowning in Oil." Now, as Chinese demand began to take off in the 2000s, it became apparent that after more than a decade of low oil prices, there simply wasn't enough supply to meet global growth in demand. The subsequent spike in oil prices provided a financial incentive for the shale boom in the US starting late that decade, 2008, 2009, and beyond. The result, US net oil imports were all the way up at 12.2 million barrels per day in 2007. And today, right, the nation, less than 20 years later, the nation is a net exporter and the world's largest producer of both oil and natural gas. So here's my point. Again, times and technologies have obviously changed over the last 160 years. None of these cycles were the same. However, they all followed a similar roadmap. First, there was complacency amid low oil prices and talk of a global glut and endless supply. Then there was a shock, a war, trade restrictions, or a secular shift in demand. And those shocks were followed by a spike in real inflation-adjusted oil prices. Ultimately, the cycle ends and we see lower prices when we see meaningful shifts, particularly in the form of new supply sources developed due to the financial incentive provided by those very same high real oil prices. And don't forget, this chart shows average annual oil prices. I'm not talking about short-term spikes in oil, such as we're seeing right now due to the situation in Iran and the disruption of tanker traffic through the Strait of Hormuz. No energy producer is going to invest significant sums, billions of dollars, in new production to chase a 2 or 3 month spike in oil prices. They need prolonged, higher oil prices on a real inflation-adjusted basis to make that level of investment worthwhile. As I said at the beginning of this video, I have updated this chart with average oil prices in 2025 and year-to-date this year, 2026. As you can see, the Iran spike doesn't even register yet. In fact, year-to-date in 2026, real oil prices are only up about $6 a barrel from 2025. And they're still below the average price in 2024. In 2024 dollar terms, oil prices averaged over $151 a barrel between 2011 and 2013. In 2026 dollars, that's equivalent to right around $160 a barrel. There's no reason to believe this cycle will be any different than any of these prior cycles I'm talking about. Just 6 months ago, the International Energy Agency, IEA, was talking about 4 million barrel a day of excess supply through the first half of 2026. This was often called the super glut, a figure that was already looking dubious before the start of Operation Epic Fury in Iran. In recent years, we've seen endless stories about the energy transition and the growth of solar in places like China. That's despite the fact that oil alone accounted for 33.6% of total global primary energy supply in 2024. That's down only slightly from 35.9% 15 years earlier in 2009. China's energy demand has grown by just under 25 exajoules over the 2019 to 2024 period. Now, coal enabled 38.8% of Chinese energy consumption growth over this 5-year period. Natural gas chipped in 18.2%, oil 15.6%, and solar less than 9%. In short, once the turmoil in the Middle East and the Strait of Hormuz dies down, oil prices will likely retreat from recent highs. No doubt about it. However, the situation in Iran is just the start of the adjustment. It's just the spark, the catalyst for the next phase of the supercycle. Global oil prices will need to remain elevated in coming years to incentive the level of exploration and development spending needed to ensure secure critical commodity supplies, and energy in particular, in coming years. That means we're going to need to see at least a few years of elevated real oil prices, much like we saw in 2011, back in the late 70s and early 1980s, and in fact back in the 1860s. That's how these cycles play out. It has little or nothing to do with Fed policy on interest rates or federal government policy on anything. We've had some big winners in the model portfolio lately in this service, and I believe the most profitable phase of this supercycle still lies ahead. However, there are some names that are looking extended right now, and other areas within energy that haven't even made their moves yet. So it's crucial to be very selective and to pick your spots carefully. If you're interested in a 30-day free trial to the paid version of this service, including access to our full model portfolio, simply tap the button below this video to claim your trial, an offer I'm extending through the end of this month, through the end of March. Thanks again for listening. I hope you found this useful.